If I were you, TJ, I go all in.
But so many advisors, Joe, say dollar cost averaging is the way to go. And I tend to agree.
TJ from Louisiana goes, hey guys, I'm hoping this will get answered on your podcast, which I love, by the way. Thank you, TJ. I need some help with a little bit of a mess. Not a bad one we find ourselves in. Quick rundown of where we sit. We got 800,000 in a 401k, 270 in a Roth, 330 in a brokerage, and about $1 million in cash. House is worth $1 million with about $600,000 in equity. We do not have debt outside of our mortgage. Most of the money's in index fund across small, medium, large, tech, value, and small portion in international. 45 years old, married with 2 boys, 17 and 15. We'll pay for college via cash flow. Question is what to do with the cash that is earning roughly 5% right now. I sold a few investments and never put it back in the market with interest rates where they were, feeling that the market is a little high. And yes, I know time in the market is not possible. I would like to get in the market, and I know time in the market is better than time out of the market. So, would you DCA?
Dollar cost average.
Thank you. Or just go all in? About 80% of cash now. Also, considering putting a pool in which would run about $100,000. Any issues with that? Thanks for the feedback. Well, invite me to the pool. I'll tell you.
I would think a pool in Louisiana would be pretty nice about right now.
Is the money, what's the money for? Is it for retirement? So outside the $100,000 pool, keep that in cash, right? And then, get your pool.
Yeah, keep your emergency fund.
Keep your emergency fund and probably another 100,000.
Yep, agreed.
And then so you got, call it 800,000 or 780. Do you dollar cost average or do you put it all in? If I were you, TJ, I go all in. I don't care where the market is, because if you need this money in 10 years from now, 20 years from now, do you think the market is going to be higher 10 years from now than it is today? If you believe that the market's going to be higher 10 years from now when you need the money, then just put it in. Dollar cost averaging is fine. It's easy. It makes you feel a little bit better because when the markets go up, you're like, oh, thank God I didn't put it all in. Or when the markets go down, you're like, oh, should I put a little bit more in? Statistics say the markets go up about 70% of the time, goes down 30% of the time. And if you need to be invested, I would have it fully invested right now in the proper allocation for your goals.
Now, but so many advisors, Joe, say dollar cost averaging is the way to go. And I tend to agree. So the thing about it is it feels better, right? Because you know you're not going to make a huge mistake. You're doing little bits each month, regardless of what the market does. If it goes up a little bit, you're happy because those shares went up in value. If it goes down, you're happy because now you're buying more shares at lower cost. So you're able to kind of manage your emotions. But if you think about it this way, Joe, kind of as you said, the way I think about it is markets on average go up 2 years and down 1 year. So in a 3-year period, markets go up twice as much as go down. So if that's true, wouldn't you just want to be invested and stay invested? And that's the argument for going all in. But you will find a lot of financial advisors that advocate dollar cost averaging. And I believe that's because it's just easier emotionally to handle.
I think most people dollar cost average. If you invest in a 401k, you're dollar cost averaging.
Well, of course. I mean, by nature, right?
Right. You're putting money in every paycheck into the overall market. Right? And so the theory is that, okay, well, let's say you're buying a stock and the stock is $2 a share. So you buy it at $2 and then it goes to $3 and then it goes back down to $2. And then, so you're averaging out the cost of the stock as you dollar cost average in. And so, yeah, sometimes the math works really well there. But if I were you, I want to get it in a globally diversified portfolio that's based on my goals and get it in, and then, all right, forget about it. But what happens is, what's going to happen to TJ?
He's going to put it in, the market's going to crash.
Exactly.
We already know that.
Exactly. That is exactly what's going to happen.
But if he doesn't put it in, the market's going to go way up. So this is the hard part about the emotion.
Right. It's impossible. Our brains are not wired to be good investors.
And so if it's easier to dollar cost average, Maybe you do something in between. Instead of doing it over 2 years, you just do like 3 chunks. You do,
I put $500,000 in today and then dollar cost average the
or
rest.
whatever. Yeah, whatever feels right to you. But just if you think about the nature of the market, it goes up more often than down. Wouldn't you want to be in the market generally? And the answer is yes.
Yeah, and I think, let's say if he takes the DCA route, right? Have a disciplined approach and a plan to do that, because your emotions are always going to get in the way as your dollar cost averaging even. So you're going to put $2,000 in a month, and then the market's going to crash, and you're going to be like, oh, I don't know, should I buy more? Should I buy less? So let me just wait, because I know that the market's going to go down a little bit more. And then when it goes down a little bit more, I'm not going to put $2,000 in. I'm going to put $200,000 in. And guess what? When you sit on the sidelines again, the market's going to skyrocket up, and you're like, oh man. So you got to get your emotion. You have to have a disciplined investment process. So if you dollar cost average in, or you put in a globally diversified portfolio, make sure that you know what you're investing in. What is the expected rate of return of the overall portfolio? What is the risk associated with those investments? And if you're comfortable with that, invest now. So, yeah, get off the sidelines.